If you're trading crypto like this, you're already losing. Not loudly, not all at once, but slowly, trade by trade. Most people believe losing traders make obvious mistakes. They imagine reckless clicks, wild leverage, emotional decisions. That's not how it really happens. In reality, most accounts don't collapse in chaos. They fade, quietly. One small decision at a time. A trade that almost worked. A stop that was moved just a little. A loss that didn't feel dangerous. Until it was. What makes this dangerous is not the market. It's the illusion of control. Because while traders are watching candles, something else is watching them. Every hesitation, every impulse, every emotional reaction disguised as strategy. Most beginners think success in crypto is about prediction, finding the perfect entry, catching the next big move. But the market doesn't reward hope. It responds to behavior. And behavior leaves patterns. Patterns that repeat. Patterns that drain accounts. Patterns that feel normal until one day the balance is gone. This is why so many traders say the same thing. I don't know what went wrong. But something did go wrong. And it happened long before the loss. Here are the key things to avoid as a crypto trader. Trading without a plan. This mistake doesn't announce itself. It doesn't look reckless. It doesn't feel dangerous. In fact, it feels flexible. A trader opens the chart. Price is moving. Something feels right. There's no written entry, no clear exit, no defined risk, just confidence. The trade wins, and that's where the damage begins, because the next trade is entered the same way, and the one after that, until one loss erases 3 wins. Another loss follows. Stops are adjusted. Targets are ignored. What was once flexibility becomes confusion. One trader described it like this. I wasn't gambling, but I wasn't following anything either. The chart didn't change. The market didn't change. But the account did. Visually, this looks harmless. Random buy points, random exits, wins and losses scattered without structure. Side by side with a planned trader, the difference is obvious. One account grows slowly. The other bleeds quietly. This mistake teaches the market how you behave. And once that behavior is learned, it gets exploited. But this is only the first layer. Because the next mistake doesn't just ignore structure, it multiplies the damage. Next is oversized risk. This mistake wears the mask of confidence. The trader has seen a few wins. The setup looks familiar, so the position size increases. Just a little. The logic sounds reasonable. If I believe more, I should commit more. The first large trade wins. Relief, validation. Then comes the loss. And suddenly, it's no longer just a loss. It's emotional weight. The screen feels closer. The heart reacts faster. Decisions speed up. A trader once said, I wasn't thinking about strategy anymore. I was thinking about getting back. That's how one bad trade becomes 3. That's how damage compounds. On a chart, this looks like a sharp drop in equity. One oversized loss pulling the entire account downward. Recovery now requires perfection. And perfection never arrives. This mistake doesn't end accounts instantly. It weakens them, leaving them vulnerable to what comes next. Because the next mistake doesn't start with risk. It starts with emotion. The third one is revenge decisions. This mistake begins after the loss. The chart hasn't changed. The setup hasn't improved. But the trader has. Focus narrows. Patience disappears. The goal shifts. It's no longer about a good trade. It's about fixing the damage. Entries happen faster. Stops feel optional. The trader isn't reacting to price anymore. They're reacting to themselves. One trader described it quietly. I knew I should stop, but stopping felt worse than losing. This is where small losses become large ones. On screen, you see it clearly. A cluster of rapid trades. No structure. No recovery. Just momentum in the wrong direction. The account doesn't disappear. It fractures. And fractured accounts don't survive volatility. But even this isn't the most dangerous mistake. The next one convinces traders they're learning, while repeating the same damage. Next point is ignoring review. This mistake happens after the trade is over. The loss is accepted. The chart is closed. No notes are taken. No questions are asked. The trader moves on. And because nothing is recorded, nothing improves. The same errors return in different forms. A missed exit, an oversized position, an emotional entry. Each one feels new. But they're not. Side by side, the evidence is clear. Screenshots with the same outcome. Different days. Same behavior. This mistake doesn't hurt today. It delays growth, and delayed growth is how traders stay trapped. Because the market doesn't punish ignorance. It profits from repetition. And the final mistake is the one most traders never realize they're making. I've seen traders who thought they were different. They didn't start reckless. They didn't start careless. They started hopeful. One of them messaged me after what he called a good week. 4 winning trades. Confidence high. Screenshots saved. He increased his size on the next setup. It made sense to him. The market moved against him, just enough to feel uncomfortable. He told himself it was temporary. He adjusted the stop. Then again. By the time the trade closed, the damage was already done. What followed wasn't panic. It was silence. No journal entry. No reflection. Just another trade. And another. By the end of the month, the account was smaller than when he started. His message ended with one sentence. I don't understand how this keeps happening. But it wasn't random. It followed a pattern. And I've seen that pattern before. During the last major run-up, many traders believed losses were temporary. They thought the market would fix their mistakes because price kept rising. One trader shared his screen history. Same setup, same entry style, same outcome. Wins were small. Losses were heavy. He was active every day. But nothing improved. When asked about his plan, he paused. There wasn't one. Only habits. Habits formed under pressure. He wasn't careless. He was consistent, just in the wrong direction. That's what makes this dangerous. Consistency without structure feels like progress, until the account tells a different story. Another message came late at night. A trader had just closed his platform. He said the screen felt heavy. He had promised himself he'd stop after one loss. He didn't. He promised himself the next trade would be cleaner. It wasn't. What stayed with him wasn't the loss itself. It was the realization. He had ignored every warning sign because none of them looked urgent. That's how most traders exit the market. Not with a single mistake, but with many small ones they learned to tolerate. I've seen traders survive huge market swings. And I've seen traders disappear in calm conditions. The difference wasn't intelligence. It wasn't experience. It was awareness. The ones who lasted noticed patterns early, in their behavior, in their emotions, in their excuses. The others kept going, believing activity meant progress. It didn't. It only made the lesson more expensive. Narrator, slight pause. If any of these stories feel familiar, it's not coincidence. Most traders walk the same path, different charts, same decisions. And what comes next is the point where most of them fail to stop. Because the next mistake doesn't feel like a mistake at all. It feels like commitment. Narrator, firm, controlled. Watch the screen carefully, because this is where most traders miss what's happening. They focus on price. They ignore patterns. This candle looks like opportunity. It convinces people they're early. But look closer. No entry rules. No exit defined. No risk measured. Just action. Side by side, the difference is obvious. One account grows slowly. The other reacts constantly. Balance counter on the left ticks up and down. Right side rises steadily. Now watch what happens next. This is where size changes. One trade carries more weight than the last three combined. It doesn't erase everything. It weakens the account. Narrator. And weakened accounts make emotional decisions. This is no longer about strategy. It's about fixing what just happened. Narrator. Most traders don't expect this moment because it didn't feel dangerous 5 minutes earlier. Look at the timing. Losses don't come spread out. They arrive clustered. This is how accounts break. Not instantly, but repeatedly. Nothing is recorded. Nothing is questioned. So nothing changes. Different session. Same behavior. This is why traders say they've been active for months and still don't understand why their account is smaller. Every habit leaves a trace. Every shortcut leaves evidence. Seen separately, these moments look harmless. Seen together, they explain everything. Most traders never pause long enough to see this frame. They move forward instead. And the next mistake is the one they defend the most, because it feels responsible, it feels committed, and it costs more than any loss before it. Narrator. Quiet, deliberate. Before we go further, pause for a moment. Think about your last trade. Not the result, the decision. Did you know exactly where you would exit if you were wrong, yes or no? Don't answer quickly, because most traders say yes, until they look at the chart history. Have you ever entered a trade and figured out the exit later? Yes or no? If your answer was yes, you're not alone. Now ask yourself this. Have you ever moved a stop because price was almost turning? Yes or no? That moment matters more than the loss itself. Pause again. Think back. Have you ever told yourself, just this one trade, I'll use more size? Yes or no? If you said yes, that decision left a mark. Here's another. After a loss, did you ever enter again without stepping away? Yes or no? This question separates traders who recover from traders who repeat damage. Now listen carefully. Narrator. Firm. Comment. Plan. If every trade you take has defined rules. If it doesn't, don't comment yet. Because awareness comes before change. I want you to pause the video here if you need to. Look at your last 5 trades. Not the wins, not the losses. The behavior. Ask yourself, which mistake shows up the most? Entering without structure? Using too much size? Acting too fast after a loss? Ignoring review completely? Comment the number in your head. You don't need to explain it. Just acknowledge it, because ignoring patterns doesn't erase them. Here's a harder question. Have you ever stayed in a trade, not because your plan said so, but because closing it felt like admitting failure? Yes or no? That hesitation has ended more trading journeys than bad analysis ever did. Think about that. Poll this in your mind. Which hurts more, a small planned loss, or watching a manageable loss grow? Your answer explains your results. One last question before we continue. Have you ever said, I'm learning even though my balance is shrinking? Yes or no? Learning leaves evidence. So does repetition. If these questions feel uncomfortable, good. Discomfort is where awareness begins. Because what comes next is the mistake traders defend the hardest. They call it discipline. They call it patience. But in reality, it keeps them locked in place. And once you understand why, you'll never justify it again. The point of no return, this is where even traders who were winning begin to lose. Not suddenly, not dramatically, but permanently. The comfort zone. There's a phase most traders don't talk about. It happens after the early mistakes. After the obvious errors are reduced. The account looks stable. Losses feel controlled. Wins feel earned. This is where confidence settles in. And that's exactly why this phase is dangerous. Because comfort slows awareness. And slow awareness misses change. The trader believes they've figured it out. They haven't. They've just entered the most convincing trap. And the next mistake only shows up once traders feel safe. The rules that bend at first. Rules are followed closely. Every entry justified. Every exit respected. Then a trade works, even though the rules were bent. Nothing bad happens. So it happens again and again, until the rules exist only when they're convenient. This is how discipline quietly changes shape. It no longer protects the account. It protects the ego. Most traders don't notice this shift because results haven't collapsed yet. But the next section is where the bill are. The day nothing works, every trader remembers this day. The setups look familiar. The strategy hasn't changed, but results have. Trades fail quickly. Stops feel too close. Entries feel late. Confusion sets in. The trader reacts by doing more. More trades. More screen time. But activity doesn't fix misalignment. It hides it. This is the point where many traders say, the market has changed. Sometimes it has. But sometimes, the trader hasn't adapted. And the next mistake decides who survives this phase. Refusing to step back, stepping away feels like giving up. So traders stay. They trade through frustration, through doubt, through exhaustion. They tell themselves consistency matters. It does, but only when it's applied to the right behavior. Consistency in the wrong state drains accounts faster than bad analysis. This is where many traders lock themselves into decline. Not because they don't know better, but because stopping feels harder than continuing. And the next mistake convinces them they're being responsible. Waiting for recovery. Some traders stop taking new risks. They tell themselves they're being careful. They wait for the account to recover on its own. But recovery doesn't happen through hope. It happens through adjustment. And adjustment requires admitting something is broken. Many traders never do. So they wait, and waiting becomes stagnation. Stagnation becomes frustration. And frustration leads back to old habits. This cycle looks calm from the outside. It isn't. The quiet exit, most traders don't leave the market after one big loss. They fade away. Less interest, less focus, less confidence. They stop reviewing. They stop questioning. Eventually, they stop showing up. Not because they failed once, but because they stayed too long without changing. This is the ending nobody plans for. And it costs more than any loss before it. Narrator, quiet, deliberate. Before we go further, pause for a moment. Think about your last trade. Not the result, the decision. Did you know exactly where you would exit if you were wrong, yes or no? Don't answer quickly, because most traders say yes, until they look at the chart history. Have you ever entered a trade and figured out the exit later? Yes or no? If your answer was yes, you're not alone. Now ask yourself this. Have you ever moved a stop because price was almost turning? Yes or no? That moment matters more than the loss itself. Pause again. Think back. Have you ever told yourself, just this one trade, I'll use more size? Yes or no? If you said yes, that decision left a mark. Here's another. After a loss, did you ever enter again without stepping away? Yes or no? This question separates traders who recover from traders who repeat damage. Now listen carefully. Narrator, firm. Comment, plan. If every trade you take has defined rules. If it doesn't, don't comment yet. Because awareness comes before change. I want you to pause the video here if you need to. Look at your last 5 trades. Not the wins, not the losses. The behavior. Ask yourself, which mistake shows up the most? Entering without structure? Using too much size? Acting too fast after a loss? Ignoring review completely? Comment the number in your head. You don't need to explain it. Just acknowledge it, because ignoring patterns doesn't erase them. Here's a harder question. Have you ever stayed in a trade, Not because your plan said so, but because closing it felt like admitting failure. Yes or no. That hesitation has ended more trading journeys than bad analysis ever did. Think about that. Poll this in your mind. Which hurts more, a small planned loss, or watching a manageable loss grow? Your answer explains your results. One last question before we continue. Have you ever said, "I'm learning even though my balance is shrinking"? Yes or no? Learning leaves evidence. So does repetition. If these questions feel uncomfortable, good. Discomfort is where awareness begins. Because what comes next is the mistake traders defend the hardest. They call it discipline. They call it patience. But in reality, it keeps them locked in place. And once you understand why, you'll never justify it again. The one mistake above all, everything you've seen so far leads to one decision. The decision traders argue for the most, defend the hardest, and regret the longest. It feels logical. It feels mature. But it silently caps growth, and once it's adopted, most traders never move past it. That's what we expose next, because this is where watching turns into awareness, and awareness decides everything. The truth traders need to see what I'm about to show you isn't a promise of profit. There are no guarantees. This isn't financial advice. It's a record of what happens when patterns repeat. And the market never forgets behavior. I'll show you both sides. The moments when traders think they've learned their lesson, and the moments when the same habits silently undo everything. Here's what the data says. Accounts with clear entries, defined exits, and consistent review survive longer. Accounts without those behaviors fade slowly, until one day, they're gone. No story here is exaggeration. No trade is fabricated. Only patterns observed over years. I've watched traders win small and lose large. I've seen accounts thrive in volatile markets, and I've seen accounts disappear quietly. In every case, the difference wasn't luck. It was behavior, repeated over time. I want to be clear. Seeing these patterns doesn't make you immune. It gives you awareness. And awareness is what prevents small mistakes from compounding into account-ending losses. This is not a shortcut to profit. This is a way to survive long enough to have a chance. Some traders dismiss warnings like these. They believe they are the exception. The next mistake they defend the hardest will prove otherwise. And that's the one we reveal next. Before we continue, consider this. Which of your trades have followed a pattern you now recognize? Which habits repeat without you noticing? Take a moment. Pause. Think. Acknowledging behavior doesn't make you weak. It makes you aware. And awareness is the only protection the market respects. Now, the mistake that traders defend the longest. The one that feels responsible, disciplined, even wise. It quietly limits growth, traps accounts, and frustrates even the most patient trader. And in the next segment, you'll see why recognizing it changes everything. There's no promise here of instant mastery. No trick to beat the market. Only truth, patterns, and the chance to protect yourself. Because once you understand this next mistake, you'll never defend it again. Comment 2. Which mistake has appeared in your trading the most? Enter a single word. Entry, size, emotion, review. No explanation needed. Just recognition. This is not about proving anything. It's about seeing clearly. And the act of acknowledging it engages your awareness. Awareness is what prevents the next small loss from becoming a critical one. Now, if you've paused and reflected, you're ready for what comes next. The next segment reveals the mistake traders defend the most. The one that feels disciplined, but silently limits growth. Recognizing it can change everything, but ignoring it costs more than any single trade ever could. If this is already helping you, like the video. It signals YouTube to show it to traders who need it most. The next section could save months of effort or prevent a critical loss. Because what follows isn't theory. It's real behavior, real accounts, and real consequences. Now, let's uncover the mistake that most traders defend. The one they refuse to admit is holding them back. And once you see it, everything before it clicks into place.